Do you want to know all the secrets to get the best interest rate on your next home loan? Well, in this video, I'm going to share with you all the secrets that you can utilize and have a step-by-step actionable plan of things you could do now to get the best deal, get the best interest rate on your next home loan. Before we dive into the meat of this video, I just kind of want to explain how interest rates work in general, okay? So most competitive banks will have very similar interest rates. They might differ a little bit, like 0.125 or 0.25, but generally you're gonna get a similar interest rate if you shop around, okay? But there are things that you could do that are in your control to put yourself in the best position to get the best interest rate possible. All right, so the first thing you wanna do is check your credit score. Your credit score is gonna have the biggest impact on what interest rate you get. And if you don't know what your credit score is, you're gonna be in for a surprise, and all the rates that you see that are advertised online and on TV, hey, you can get a 3.5. When we're filming this video, it is October 15th, 2019. Interest rates are really good. Historically, some of the best times ever, but having a bad credit score can really kill you. So for example, if you're buying a house and you're putting 20% down, you know, the house is $500,000 and you're gonna get a loan for $400,000, the minimum credit score for a conventional loan is 5%, okay? So if you have the bare minimum to get a conventional loan, you're looking at a 5% interest, and not only that, that interest rate, because your credit's so low, is gonna cost you $5,000. $5,000 on top of all your other closing costs to get a 5% rate. Now, on the flip side, if you have an excellent credit score, 780 or higher, your interest rate as of today would be 3.75%. That's a difference of 1.25% on the biggest piece of debt that you have. That's a huge freaking difference, guys. It's huge. And your credit score is completely in your control. So you could take a hold of that. You can take control of your credit score, raise it, and save yourself a shitload of interest. So on the example that I just talked about, if the loan is $400,000, the difference between 5% and 3.75% is $295 a month. That's $300 every single month that you would have to pay more if you don't fix your credit. Okay, so now you might be asking, well, Roger, what could I do to improve my credit score? Don't worry, I'm gonna tell you. So the first thing you could do, the easiest thing, pay your bills on time. Okay, if you miss a credit card payment, your score could drop 40 or 50 points. And that's the difference of like 0.5% on a mortgage, okay? So pay your credit cards on time. If you have trouble with this has happened to me where I don't get a credit card bill, it comes in the mail, maybe it didn't come, or maybe I missed it, I miss a payment. And if this has happened to you, set up auto pay. Set up auto pay for the bare minimum, that way you never have to worry about ever missing a credit card payment. So another thing you could do to help increase your score is ideally what you want is you want your credit card balance to be 30% or less of the total available balance. So hopefully that made sense, but if it didn't, here's an example. Let's say you have a credit card. Let's say the limit is $10,000, right? You could spend up to $10,000. Ideally, you want your balance to be 30% or less. Okay, so $3,000 or less. So the lower the percentage, especially 30. 30 is the magic number. If you get it under 30, it's gonna really boost your score. If it's over 30, then it's like, okay, you're relying a little bit too much on the credit card. So get those credit cards down to 30% or lower. That'll significantly help your credit score and get you the best deal on your next mortgage. All right, the next thing you wanna do to get the best deal when you're ready to buy your dream house is to make sure you have at least 3 trade lines. Okay, so 3 credit cards or 2 credit cards and a car loan. Whatever the combination is, you want to have at least 3 trade lines. So any combination is fine. The banks, the credit reporting agencies, the banks, They want to see that you can manage several accounts, right? Show us you're responsible. Show us you can manage 3, 4, 5 accounts. If you only have one credit card or two, that's actually gonna limit how high your score can go. If you have 3, 4, 5 credit cards and you're keeping 30% or less, or even keeping them at 0, you're gonna have a much higher score. So even if you keep them all at 0 and you have 5 credit cards, you're gonna have a better score than someone who has 1 credit card and has a 0 balance. So you guys both have 0 balances, but you'll have a better credit score because it shows you can manage more accounts. So if you're planning on buying a house sometime in the next 6 months, get those accounts open now. If you don't have 3, open up another 1 or 2, get up to 3 accounts, because once you start the home buying process, you don't want to apply for your 3rd card or apply for any kind of debt during the mortgage process. You want to keep your credit activity as low as possible because you don't want any red flags, you don't want any new accounts. So get it set up now. That way, when the time comes in 6 months, it's already open and ready to go. All right, so the biggest factor that's gonna determine what interest rate you get is your credit score, and it's completely in your control. So utilize these tips that I gave you, and if you want some more information, you can check out this video that I made on how to improve your credit score. The next biggest factor on what interest rate you get when you buy your dream house is how much of a down payment you put. So it's simple. The more down payment, the lower the interest rate, okay? More down payment, lower rate. The lower you put as a down payment, the rate's gonna be a little bit higher, okay? So on a conventional loan, you can actually put as little as 5% down. But if you put 5% down versus 10, 15, or 20, you're gonna get a little bit of a higher rate, okay? So I know that's something that is, you know, if you have 10% and that's all you have, there's nothing you could do. But if you're blessed enough to have a family member or someone that can help you, let's say you have 8% or 9%, and you just need a little bit more cash to get to that next tier, you can have a friend or family member gift you the rest of that 1 or 2%, okay? So you can actually do that. You can receive gift funds from a family member to put towards your loan. So if you're off by just a little bit, consider asking for a short-term loan. Say, hey, I'd like to borrow a couple grand, I'll pay you back within a year, or whatever the case. Try to do something, because that's gonna help you get a better rate on the mortgage. All right, so credit score, down payment, those are the 2 biggest factors in order to get the best rate possible. The credit score is maybe more in your control, the down payment not as much, but those are 2 things that you should understand. Those are gonna determine what kind of interest rate you get. And keep in mind, you don't need 20% to buy a house. You can have 5%. But any loan that you get with less than 20% down is gonna have some kind of mortgage insurance. Just keep that in mind. Mortgage insurance is just an extra fee added to your loan every month because it's a riskier loan because you put a little bit of a lower down payment, okay? So the banks wanna protect themselves. They make you get insurance, which is usually 100, 200 bucks because you're putting less than 20% down. The third thing that you need to consider and understand is your city and county's loan limits, okay? So depending on the size of your loan, rates are gonna be different. So let's just take LA County, for example, because that's where I am. So LA County has, every county has different loan limits. So LA County, San Diego, San Francisco, Riverside, Temecula, Bakersfield, whatever. I don't know if Bakersfield is its own county, but anyway, every county has different loan limits. So I'm just gonna use LA County for our example. So basically in LA County, any loan up to $484,000 is considered a conventional conforming loan. Any loan in that range is gonna have the best interest rate, okay? So yeah, there are areas in LA where it's expensive. You'd have to put 50% or more down to get that loan, but whatever, that is what it is. But just keep in mind that any loan up to 484 is gonna get you the best rate. All right, so that's tier 1, okay? The next tier up, if your loan is between 484 and 726, it's considered high balance. High balance is the next tier up, and the rates are a little bit higher, okay? So you gotta understand how the banks look at it is the more money we're loaning you to one person, the bigger of a risk it is. So how the banks work is the bigger the risk, the bigger the interest rate. That's basically how they're looking at it. Is if you're a risky person, riskier than the next person, we're gonna charge you a little bit more. So loan amounts between 484 and 726 are considered high balance in LA County. It might be different in your county. You can easily, I'll leave the link in the description below. If you want to look up your county and see what the limits are in your county, you can do so. But in LA County, loans between 484 and 726 are considered high balance and will be a little bit higher than conventional. Okay, so the next tier up is any loan that's 726,000 or higher in LA County is considered a jumbo loan. So jumbo loans are basically essentially private money loans. And they're not backed by Fannie Mae, they're not backed by Freddie Mac, and the rates on those are gonna be even higher than high balance loans. So like I mentioned earlier, if the bank is loaning you $1 million, that's to one person, they're loaning $1 million to one person, that's riskier, and they will charge you a little bit of a higher interest rate for that risk. So here's another tip that you can utilize if you are on the verge of one of these tiers, right? Let's say your loan was gonna be 486. You were gonna put 10% down, your loan's gonna be 486. Guess what? If you can come up with an extra $2,000, get it down from 486 to 484, you're gonna get a better rate, okay? So that's why it's important to know and understand these loan limits, because if you're right there and you can, hey, oh, I can come out of pocket another $1,000 and I can get a better rate, 0.25% better, why not? It's a good idea, and it's a good idea to consider doing that if you're on the cusp of being in a higher loan limit. And the fourth biggest factor that the banks are gonna look at when giving you a loan are property type and occupancy type. So, property type, let's talk about that for a second. If you're buying a single family home, your interest rate is gonna be better than if you buy a condo, okay? Interest rates on condos are higher than a single family home. They can be 0.25 to 0.5% higher than a single family home. If you are buying a 2 to 4 unit property, interest rates are gonna be different, okay? So that's what property type means. So just a heads up, this is the same no matter where you go, okay? No matter what bank you go to, interest rates on condos are gonna be higher. Interest rates on 2 to 4 units are gonna be higher, okay? Depends on the property type. The other thing is occupancy type, right? Are you buying this house as your primary residence? If this is gonna be your primary house, then you're gonna get a better rate. If it's gonna be an investment property, the rate's gonna be much higher. Actually, right now, interest rates on investment properties, if you're like, hey bank, I'm gonna buy a house, it's gonna be an investment property. First of all, you have to put 20% down. You can't put 5% on an investment property. So you have to put 20%, and the rate's gonna be a 0.1% higher, sometimes more. Sometimes it's 1.5% higher than if it's your primary house. So the rules change drastically if it's a condo, single family, 2 to 4 unit, or if it's gonna be your primary residence, or if it's gonna be an investment property. The third occupancy type that's possible is second home. Okay, so the bank will consider a second home, give you a good rate, just like if it's your primary house. But then there are other rules that have to apply. So for example, if you have a second home, it has to be at least 100 miles from your other house. Because then the bank looks at it like, okay, if you have a vacation home or a second home, that makes sense. But if they're too close together, are you really living in both? So that's another option when you're buying another house, whether it's an investment or your primary house. Hey, can it, is second home a possibility? So these are the things that you gotta know going into the home buying process. So if you guys have any questions or comments, please leave them below. If you found this video valuable, you got something out of it, just give me a thumbs up, hit the like button, subscribe, share the love. I appreciate all of you. Thank you guys so much. And if you know someone who's looking to buy a house, a friend or family member who might find this valuable, please feel free to share it with them. Happy to answer any other questions that you guys may have. Have a blessed day, and I'll see you guys soon.